Commerzbank. So the numbers were from the end of June last year, according to this picture that we had. That was from Standard & Poor's. So above 100%. So Commerzbank last spring, the revenue fell, and the expenses went up. So Commerzbank has been struggling for years to return to a profitable business, and they have had major restructurings, and for example, they have laid quite significant proportion of the employees off, but that has not yet led to the bank become efficient. Don't ask me kind of the details. According to Standard & Poor's, the cost-to-income ratio was 107. According to Commerzbank itself, they reported cost-to-income something like 90, was it 95 or so. What is the difference? I can't tell you, but whenever, whatever kind of even 90 plus something is clearly a number which is not good. As we saw, the average kind of is in European banks is somewhere around 60 to 70% cost to income. If it is kind of close to 100, obviously kind of the bank essentially is cannot make profits. If that is for longer term, that was only for half a year period, but still shows that Commerzbank has had major efficiency challenges, and they have now launched another, again, one long-term strategy, which, for example, implies further closures of branches, as we saw in Aktia's case. So that is what banks have been doing for years now. Banks are closing their branches, they have been developing services online, and that is something that European, say Nordic banks have been pretty early on this process, while German and Southern European banks have been a bit slower. There was a question about Aktia's bond issuance last week, which was published. Turned out that it was a covered bond, so meaning that it's not a normal bond. Covered bonds are a bit kind of a specific products, bank-specific products, somewhat kind of even complicated, you would say, in terms. So that was the reason to explain why the yield was even lower than the usual bonds. But that is kind of a detailed question. And it's not kind of let's not go into that kind of a specific topic in more detail on this course. Any other questions that you might have on the topics that we were discussing on Tuesday or something else? And please add those on the chat. You can also send me email after the lecture if you like. Today's topic is central banks. Last week's Financial Times article, there was an interview of Christine Lagarde, whom we know. We know her from her role as in her job. She was the finance minister of France. Then she became the head of IMF, and nowadays the president of or chairman of European Central Bank. She said that European Central Bank is not in a hurry to raise interest rates, as this article refers to. Every reason not to act as quickly or as ruthlessly as the US Federal Reserve. While we are living pretty interesting times is that yesterday evening, I don't know whether you watched this, it was Finnish time, 9:30 in the evening. There was a live press conference from Fed, in which the Chairman Powell made a, by the way, something that kind of Fed has its own YouTube channel, which you can follow its press conferences, and also you can take a look at if you are interested in the previous ones on this address. So what happened there was that this was something, it was a big thing. It wasn't like this kind of I can tell you, kind of 10 years ago, 20 years ago, that yesterday everybody, I don't know everybody, but kind of in the news, not only in financial news, but kind of in the other news also, there was kind of there were articles kind of speculating that what Fed will do. So this is just one signal, one indicator of how the importance of central banks' actions have become more of wider interest. And obviously, of course, if they make significant changes in their policy, that influences everybody's not only investment portfolios, but say mortgage loans via interest rates could have consequences on via the interest rates, could have implications to employment, prices, whatever. So this was something that was highly anticipated. Then when it really took place, what it was about. So Powell first gave was it 8-9 minutes kind of a summary of the Fed's decisions, and then there was something like 45 minutes Q&A by different reporters. Very interesting as such. We'll take a look at kind of on their decisions at the end of this lecture. So interesting times we are living in terms of the relevance and importance of what central bankers do decide. Not exactly related. Yeah, good reminder, and that is something that I has as on my my list as well, to remind you that tomorrow at 4 o'clock is the deadline for the Deliveroo case. Until now, I have received 7 submissions, so it looks that you are taking all the time, most of you, kind of to finish your report. Just to remind you that the deadline is by 4. The question is that the style, citations in text, and a list of references expected, or footnote citations are okay. Both are okay. So content matters, not the style as such. It would be helpful as I said, I actually wrote to you kind of earlier on. So the questions 9, 10, 11, 12 kind of require some external citations, but the first one's kind of the idea is that this Deliveroo's IPO prospectus is enough, but when you cite, it would be helpful if you cite the page number. So that is kind of just for me when I read those, so I can see that kind of on which page you found the answer. But otherwise, style is kind of up to you to decide. Good. Okay, so central banks. Before going to central banks, I thought that for the sake of clarity, a few terms, 2 terms that actually I have discussed. I thought that, okay, I have been talking about the TARP program at least one time. What it was, this was mentioned in this Inside Job movie, TARP, Troubled Asset Relief Program. That was in autumn 2008, in the midst of this global financial crisis in the US. So it allowed the Treasury to pump money into failing banks. So essentially that money, it was decided to be 700 billion, and that had a major effect on the markets, as markets recognized and learned that this money is available. So that was used mostly by banks and insurance companies to capitalize themselves. It was earmarked in the sense that the banks who accepted this capital injection kind of needed to commit to somewhat strict rules, such as accept that they are not paying bonuses or dividends before they have paid this TARP money back. A smaller proportion of this was to bail out American car industry, some car companies. Later on, this was a big thing. Then politically, it was not easy to pass, but it was passed and accepted. Later on, we have learned that this money has been paid back. First of all 700 billion was not needed. It was reduced to 475 billion. And all the money has been paid, plus the interest. So you would say that in hindsight, it was a pretty good decision by the Treasury to solve kind of the problems in then the financial environment, the uncertainties that kind of can banks trust each other? Is there a risk that another bank after Lehman will go belly up and so on? Banca Monte dei Paschi di Siena, that's something I also have been mentioned. So that is, as I told you, it's the oldest bank in the world, founded 1472. It is operating, as we can see in different rankings. It's still not doing too well. It is listed. The stock price is very close to zero, but it was bailed out by the Italian government in 2017. It's 68% owned by Italian government. So, but it's still, the rest is kind of owned by external shareholders. So that's Banca Monte dei Paschi di Siena, just as a one specific bank showing kind of the oldest bank is facing these kind of difficulties. It has been facing these difficulties ever for more than 10 years, and still not kind of totally solved all the challenges. Okay, now today's central banks. We'll talk about mostly American central banking system and European system. We'll discuss about different central bank tools, lending to banks. Banks have the option to deposit at central bank, open market operations, reserve requirements, and the real effects of these tools on the real economy. So that is, as we call, Main Street. Central bank's goals, price stability, and other goals. We'll discuss about central bank's response to the crises. So first, global financial crisis, Euro crisis, and now the COVID crisis. And as the last topic, we'll talk about the effects of negative rates on banks. Central banks are governmental institutions, authorities in charge of monetary policy, and they have the actions do affect interest rates, credit supply, money supply, inflation. So many implications in real world, in real financial world, they do have. They originally emerged as a response to bank failures and substantial losses to depositors. So banks taking too much risks realizing, so the depositors lost money for example, in Great Recession in 1930s in the US. So the role of central bank ever since has been of greater importance. European system of central banks is that the Euro system consists of the ECB and 19 central banks. Founded in 1999, what is important to understand is that the decisions are made on a centralized manner by European Central Bank, but they are implemented via national central banks in a decentralized way. So the decisions are made on the European level, but decisions are made in Finland by the Bank of Finland, for example. Plus only that we know after 2014, the ECB currently supervises the Europe's largest banks. So they also have a supervisory role, which they did not have beforehand. So this is a specific Euro-specific kind of a task that they have. American Federal Reserve System is let's not go into its complexity kind of more than mentioning that the Fed system consists of 12 Federal Reserve banks, Board of Governors, and the Open Market Committee. So the ownership of Fed and all these committees, it's a pretty complex system as such. Anyway, what's enough for us is that Chairman Powell, when he makes a speech, so he speaks for Fed. The decisions are made kind of as yesterday, as he was referring to that the decisions that were made, they were after 2-day meeting. So they do have these meetings and they do have differing opinions, which I'll have an example later on which they are pretty transparent as well. In public, every now and then we hear that there are independent Federal Reserve Bank representatives who make their statements, their opinions. They sometimes disagree with the Fed's decisions, and that is kind of that is a market practice that is accepted as such. While in Europe, typically what you see is that the European Central Bank, the local central bankers do not kind of comment, have different differing opinions or comments on the ECB's role. Founded in 1913, each Federal Reserve Bank has 9 directors that represent professional bankers, prominent business leaders, and public interests. So that is kind of structured a bit different than ECB. Content-wise, this one picture shows pretty nicely how different central banks, they are not using the same kind of toolbox, the tools that they all might have, but such as in Euro area, European Central Bank has ended up using large-scale asset purchases. They use something called forward guidance. They have ended up negative interest rates, deposit tiering, and targeted lending. While Fed has not utilized all these, so central banks have had a somewhat different approach to the recent financial crises. So they are not all the same. One thing which is relatively new is that the question is that what do central banks do? Why do they end up with the policy that they have that they are publishing? So it's only until 2015 when European Central Bank also started publishing its meeting minutes. So until that, those were not public information, while in the US, for example, and in Bank of England and Bank of Japan, they had been making these minutes public. In Europe, the key concern was something called renationalization of monetary policy. So when the minutes are being published, so it might be that as you might just think that Germany might have different kind of stance to say fight against inflation. It used to be at least than France or Italy or Greece, and to keep this to avoid these the fights, kind of nationwide fights kind of within Europe. So they were not willing to publish, but there was a pressure for them to start publishing their minutes, and they started publishing them in 2015. They are not published kind of immediately, there's a delay, but afterwards we can see that what they were discussing. This is an example from their, just one example, which is content-wise also interesting. We'll discuss this later. This was in 2019. They did then decide about the interest rates, net purchases of assets, and something else. TLTRO3. So we'll go through these kind of what these mean and kind of what the specific minutes, why that was relevant, why that was interesting. We'll come back on these minutes kind of at the end of this lecture. So they are relatively transparent nowadays. Central banks, they do have different tools. Banks are allowed to borrow reserves from the central bank, and banks are able to make deposits on the central bank. So that is the central bank's role. Used to be, as Aktia, we have been using as like a case company on this course. So Aktia used to be a few years back. Aktia was a central bank in Finland of the local savings banks, but it no longer is. But it used to be kind of so local savings banks were able to make deposits to Aktia, and they were able to borrow from Aktia. European Central Bank acts as the central bank of the commercial banks. So nowadays Aktia can make deposits on European Central Bank, and it can borrow. There's a difference, typically 1%. So the deposits that banks make are 1% less, earn 1% less interest than the what is the borrowing rate from central bank. Well, this what makes this extremely interesting is that as we have been talking about the zero interest rate environment in Europe for some time, that is something that Mikko Auf was also referring to. So in Europe, the ECB set the deposit rate negative in 2014. So when the local bank from Finland or Spain or France or Germany makes this deposit on the European Central Bank, they are not being paid, but they need to pay something. So that is pretty costly. So that has led to kind of a not only somewhat, but pretty significant obstacle or burden for banks' profitability. And this is, as we'll see, it's pretty, you would say, unheard of. Now you are so young that kind of you have got used to this kind of, it has been there for many years already, still is, but it is kind of historically pretty unknown. There have been very short episodes in Sweden and in Switzerland beforehand when we have seen negative deposit rates, but now it looks that kind of this has taken obviously this has taken much longer than usually. One tool that central banks do have, thinking of the banking, what banking in its basic form, as it historically was for hundreds of years, banks were taking deposits. Deposits are liquid. So customer having kind of a bank deposit can, whenever tomorrow I decide, okay, I will take my money in cash. So bank has an obligation to provide that in cash. But banks, when they receive these deposits, they make loans, and loans inherently they are illiquid. So mortgage loan, so for 20 years, or corporate loan, that is illiquid. And if it happens that depositors want their money withdraw, many of them at the same time, as the money is not in a liquid form in a bank, that might lead to insolvency of a bank. Bank is not able to pay customers. It is somehow endogenous, as it depends on how big proportion, how illiquid these loans are. And if customers learn that now bank has made illiquid loans and the loan book is not performing well, so customers might get nervous and go to the bank in crowds and ask for their money back, because they get kind of scared that they might not get their money back, which is as such, if there are large groups asking for the money in liquid form, will force the bank, insolvent as such. So to avoid this, as there is this pay on demand, so there is an inherent risk in banking. As we were discussing, as I suggested then a couple of lectures ago, while an Icelandic bank, Kaupthing, which was closed by the Financial Supervisory Authority in Finland years back, it was a relatively small player, but the news made the customers of Nordea, OP, then Danske nervous. And even though there was no reason to get nervous, customers started queuing next morning in OP, Nordea, Danske's offices, branches. As the lesson from this is that when customers get nervous, they do get nervous. So whatever, is there a reason or not, there is some reason the customers get nervous. And then the end result for this was that Nordea, OP, Danske decided, and they came public and said, okay, we will back up Kaupthing's loans or in this case deposits, the liabilities. Bank has a liability to customer, bank has made a deposit, so bank has a liability, so they will back up these liabilities, even though they otherwise there was no need, but just to calm down depositors. Now there's a question that I have never really understood, why central banks aim for inflation to. Actually, let me come back on this as we'll take a look at the explanations that central banks have had on their policy. Let me come back on that. It's the idea is that small inflation is the optimal, deflation is the worst for the economy. So to avoid deflation, if the target was 0%, there's a great risk that the economy, there will be a deflationary environment. So 2% has been decided as the optimal, close to 2%. Okay, let's come back onto these reserve requirements. As there is the banking system is inherently fragile, because depositors have this pay on demand option. So how about creating a bank for the banks? that provides money in case of huge demand. And that is, let's call that central bank, and that is something called lender of last resort. So we know that there is a central bank which will provide these payments if one specific bank is not able to do that. That in turn, that kind of makes sense. That kind of let's build a central bank, but if we have this kind of a system for one individual bank, that would lead to an incentive kind of that okay, we can make any loans that we like because we can rely on the lender of last resort kind of to bail us out whatever happens. So that's why the central bank, after it has been kind of built or it starts operation, they do require certain reserves from local banks, not to avoid banks kind of excessive lending. And so that is in ECB, it has a 1% of the total amount of checking deposits must be kind of deposited as a reserve. And this is now 1% in Europe. Central bank can increase that. By increasing that, the central bank kind of makes it more appealing for the banks to lend money. And it can lower that kind of, and it's kind of easing the conditions for lending. It's rarely used, kind of the changes, but it is kind of one of the cornerstones of central banks' policy. Okay, they accept their role as a lender of last resort, but they require banks to make these keep these reserves, which is 1% of the total amounts. ECB or central banks typically have other monetary tools as well. Reserve requirements is one. Open market operations in short term and long term are one. That is something that we discuss. And standing facilities, as we were discussing, deposit facility, lending facility, banks can kind of commercial banks can make deposits and they can borrow from why many? Why so many? Bank lending facilities, this lender of last resort, that is kind of understandable, you could say. Open market operations, this lender of last resort function is important in terms of the confidence of the system, to avoid, not totally avoid, but kind of as much avoid as possible the risk that customers become nervous and starting taking the deposits kind of from the bank in cash. So that is kind of a needed feature of the system. Open market operations, central bank can do whatever. They can buy anything, as we were discussing on the second lecture. They can buy government bonds. They can buy corporate bonds. They can buy investment grade corporate bonds. They can buy junk bonds, as they have been doing recently. They can buy mortgage-backed securities. They can buy even shares, as we can see. Swiss central bank is a relatively big owner of some Finnish company, real companies, industrial companies, for example. Has been the policy in Japan for a long time. Is it good or bad? That is kind of, you can debate. But central bank can, in theory, buy anything. It's easily reversed, but I added there, at least in theory, as we have been seeing kind of, that is a key kind of question yesterday, in yesterday's Fed's announcement was that how can central bank start taking steps back as they have become such a big player in the market. So they have bought such a big chunk of different kind of bonds. So are there risks in them kind of first in the tapering? So that is kind of stopping these new purchases and maybe at one point kind of started selling these bonds. So that it's not so easy in practice. So in theory it's easy. They can buy, they can sell, but in practice it is a bit challenging. reserve requirements affect all banks equally. That is kind of a, you could say, fair. It's difficult to change quickly, and you could say this is something that we'll discuss on next Tuesday as we'll talk about the regulation. You can, and that is something that banks are complaining, that since financial crisis, all the regulation has been tightened. The capital requirements, as we have been seeing, tightened, and there are other regulation as well. Reserve requirements are kind of they influence banks, but not other financial institutions. So in a way, kind of this regulation discriminates banks versus others, such kind of called shadow banks. So there's a limit how much you can do something, but how much you should, how much the ECB should act on this side. So that is something to consider. Central bank's goals. Please kind of add your questions there. We could do so that kind of in a couple of minutes time, we'll have a 5-minute coffee break, and I will take a look at your questions then and try to answer, or let's take a look at them kind of after the coffee break. Before going for coffee, central bank goals. Price stability, as one of your questions is 2%. Policymakers have come to recognize the social and economic cost of inflation. So inflation should not be kind of too high. So price stability has become the primary focus of central banks. Typically, some nominal outcomes such as kind of a, say, close to 2% is pretty commonly used as a target. Other possible goals, high employment, could be economic growth, stability of financial markets, interest-based stability, say currency stability, but you can't have these all. And it's something that is extremely interesting. I encourage you to watch that kind of yesterday's Powell's YouTube presentation. As in the US, the Fed has something called dual mandate. So they target both inflation plus the employment. And now, as he yesterday, he said that in just 6 months' time in the US, was it so that the unemployment rate has gone down in 6 months by 2 percentage points to the level of 3.9, so very low currently. So that is good. But if as there are now pressures to start raising interest rates, if they start raising interest rates kind of significantly, that will easily kind of cool the economy, which would then eventually lead to higher unemployment rate. So, but in the US, so they need to balance between these two different goals. In euro, it's price stability only, while in the US, as I said, it's a dual mandate. So it's maximizing employment, minimizing unemployment, and stable prices. So US Fed has dual mandate, when in Europe the target is only kind of the target inflation, and which inflation? Consumer price inflation. So as we were discussing then on the second lecture, so asset price inflation has been massive, or say pretty massive for many years, but that is not something that the central bank is that much concerned. Yesterday, Powell was asked that is Fed's decision impacted by the recent volatility in the financial markets, such as the stock market, and he somehow said that okay, they of course they keep eye on everything, but their task, not directly, is to target any. Of course, they don't target any stock prices, but kind of a stock prices do have, and the volatility has implications for consumer kind of behavior. but they are targeting inflation, which is kind of look at that kind of a video. You could say that what was the news? It has been kind of anticipated for months already that at some stage Fed, there will be pressure for Fed to kind of start increasing interest rates. Yesterday they said that they might do that, most probably will do that, and they focus on inflation, and inflation has been kind of clearly above 2%. But still, so what was the content? What was the news? But market has been so nervous that within that close to an hour's kind of presentation, kind of or Q&A, so the Nasdaq index, which was it some before they started, it was plus 2%, and then it went minus 2%. So it went down by 4%, just as Powell was confirming that they very closely kind of follow what inflation is, and everybody knows that inflation is in the US 7%, so clearly above 2%. So what was the news? Kind of, but market thought that it was kind of too much emphasizing the inflation. So market got a bit nervous. Then eventually, by the end of the day, it recovered close to zero. Here, one example of first two reasons I took this just copy of a 1 minutes of Fed Board of Governors of Fed. First, what they said in 2016, they referred to labor market, which has continued to strengthen, and that was actually what yesterday also Paul was referring to, this unemployment, and inflation has continued to run below the committee's 2%. Consistent with the statutory mandatory, the committee seeks to foster maximum unemployment and price stability. So they they always refer to the employment, but if you look at kind of when Mario Draghi was the previous, now the Christine Lagarde kind of presenting ECB's policy, so employment is kind of not the priority there, so it's kind of just inflation. The second reason I have in here was that at that time Janet Yellen was the chairman, so they also publicly say kind of disclose the voting results, who were for, who were against, which is pretty interesting. I find it pretty interesting, pretty transparent. This is something that European Central Bank does not do. So we know from previous that Fed has been really active in purchasing different assets, treasury securities, mortgage-backed securities. So its balance sheet has become massively greater than it was. It was already in November last year, and it was kind of the news that for the first time since pandemic, it's easing off the gas. So stepping on the brakes, starting something called tapering. So this was already kind of public information in November. It's time to taper, we think, because economy has made substantial progress towards our goals, and that was something that yesterday was just, you would say, nothing new to this, but then now they concretely said, okay, there really will be tapering, not only kind of planning to taper. How about if we have a 5-minute break here, and then I will kind of take a look at your questions, which I can see that it's nice to see so many. 5-minute break, let's grab some coffee, and then we'll kind of continue on central bank's responses to the crisis. 5 minutes. Okay, welcome back. Excellent questions. The first one, on a first kind of that was about the Danish banks offering negative interest rate for mortgage loans, which was the first time was it kind of 2 years ago. Doesn't this directly harm their profits? And you are right. Of course, kind of offering mortgage loan and kind of accepting the interest rate is negative. So kind of you offer a loan and then you pay for that. So kind of for the customer. So kind of it's not good. How is that possible? So in specific kind of markets, such as in Denmark, it seems that it has been possible, and how that is being solved is as there is an answer kind of that Jose is answering kind of it could be that they do not need, bank thinks that they do not need to be that profitable as long as you get the customer in customer acquisition. So that is a kind of might make sense. And then after you get this customer, you can sell the customer additional products such as kind of a interest rate caps, so kind of insurances. You can, and after that you can some payments. It might be that you require that you ask the customer to become kind of to move his banking business, kind of other banking businesses, kind of to this specific bank as well. After which you can sell him or her kind of savings products, insurances, and so on. So overall, kind of a customer might become kind of profitable. But the biggest thing, I guess, there is that in Denmark also the deposit rates were negative. I don't know. I haven't. That was 2 years ago. I haven't checked kind of recently. But bank deposits, the interest was not even zero, but negative. While in Finland, there is a legislation which restricts that even though you might have had your, which is the most case in most of the case contracts, so the mortgage loans is linked to the Euribor rate, so it might be Euribor rate plus, say, 0.5% when the Euribor rates were minus 0.6. So effectively, negative, the interest would have been negative, but there is a floor that of zero. So that is kind of a Finnish legislation prevents kind of that pricing. Plus, as we see in the Finnish market practice is that the lowest that one can earn on bank deposit seems to be zero. It was in Germany, Switzerland, and in Denmark, especially for private banking clients, which means that they are the wealthy clients. So any deposits above 1 million, or in Denmark, they were, the last time I checked that, above 500,000 euros. So the deposits went negative. But kind of the majority of the deposits earned at least zero. It is the case also in Finland that kind of companies or institutions have had negative interest rates for some time, for years now already. So as such an example, kind of it's not household representatives, kind of individuals do not need to pay negative interest rate, but as Danske, for example, I have one company, investment company, they're having a bank account on Danske. So any deposit above 300,000 euros, I need to pay interest. So interest is negative already in Danske in Finland as well. So obviously that has led to profitability challenges for banks, these negative interest rates. Then the question from Samsa was that the employment, this is kind of as we can see that central banks might have different objectives, and it's not self-evident what it should be. It has been decided that in US it is employment and price stability, while in Europe price stability. But it's not self-evident that this is the optimal, but it has been decided that this is the way to go. Then another question is that, do you think that it's even possible without the effect of markets negatively and forced to kind of scale down? Just to make sure that, first of all, we must be humble here and kind of don't pretend that we know something that what will happen. It is kind of a trillion. It's not a $1 million question. It's kind of a $1 trillion question. What will happen? What is possible? Nobody knows. First of all, as we were discussing on, I was trying to highlight on the second lecture. Central banks are such sizable players in the market that this has never tried before. So we can't learn from the practice. So this is something. It's new situation that where central banks. So to know what would happen if central banks kind of start doing some new maneuvers in the markets. So we can only speculate. But if you ask me, and that is just my personal kind of gut feeling, that's not knowledge. It cannot be knowledge. My gut feeling is that they really find it's really difficult to find kind of to figure out that how could they somehow let interest rates kind of go up for the very simple reason. For one reason, first of all, it would kind of lead to economic kind of growth slowing, which is not politically good accepted. But the biggest thing is that that's something that I was trying to highlight on the second lecture was that as the debt levels are currently so high that kind of any increase in the interest rates will harm the ones who have these loans. So simply, the debt levels are so high that it's really, I can't figure out kind of allowing interest rates to go to say 2-3%, which it easily would be needed to kind of kill inflation, which is currently at 7%. So it's I can only see kind of difficult kind of decisions for Fed to do, even worse in Europe. So that is kind of it's really kind of never seen this interesting kind of environment, and kind of central banks are kind of they're in the corner. So the way out there, it's not easy to see how that can be done. Then the question about the exam, that is something I thought kind of say at the end, but I can say it here while you still are here. Kind of so that will be online. I will kind of confirm that by writing on my courses. So yesterday we were asked that how will we organize the exams. So as it looks that it will be possible to organize that kind of in person here on campus, but as we are 257 kind of on this class, so kind of I guess kind of, and we were kind of indirectly kind of it was an indication that having it online still would be somewhat favored. So I told that on this course we will have it online. How? I will explain you later. So what the exam will be like. So I will explain you later, but online, yeah. So not here on campus. Okay, let's move on. Bubbles. So how they have kind of responded to the bubbles. Bubbles are different, and the bubbles we learn afterwards that it really was a bubble. While in a bubble, there's a question of is this bubble or not. Credit-driven bubble, you could say that there are easy terms, very terms spill over to the asset prices. So asset prices kind of go up. Sometimes there's optimism-driven bubble, just people becoming optimistic. Question is that should central banks respond to bubbles? You could say that in a credit bubble, such as in before 2007-8, at hindsight, it's easy to say that they should have responded as they did. When techno bubble in 97, 98, 99 until March 2000, it was not about kind of a central bank policy as such. It's just kind of investors became too excited about kind of the future prospects of techno companies. You could say that central banks should not kind of intervene markets. As we were discussing, they did when the bubble burst. Kind of the put option that central bank kind of provided to the market. So kind of of course, we can say afterwards what should have been done. One in bubble. The question: are we in bubble currently? If you look at the share prices, the real estate prices, especially bond prices, while bond yields, especially in Europe, are zero. So are we in bubble currently? What should be done? What can be done? So that is it's very complicated question. That is something that central banks need to kind of tackle. Something that kind of as a separate topic, but it's not separate in sense, it has to do with central banks, but something that we have got used to is this forward guidance. Especially first in the UK and USA, central banks had started a practice that they guide the future. So they tell in advance not only what they have done. Not only they explain why they started some operations, why they lowered the interest rates, where they increased the interest rates, but they also verbally kind of convey information, communicate to the markets what they plan to do. And that is kind of, it's well taken by the market, but it is a pretty risky strategy, as one could say that investors may take excessive risk if you learn that central banks promise that we will keep interest rate at the zero level. Of course, it's rational to borrow as much as you can. So that is for various reasons, one could question this policy, but that is what we have got used to. That will lead to more borrowing, that will lead to kind of more leverage and illiquid positions, which might and easily might lead to kind of a excessive risk taking and bubble kind of being building for sense of security, which is actually central banks have themselves admitted or recognized. It's not central banks that they live in vacuum. They of course understand. This is from European Central Bank annual report 2015. I once took this kind of as a copy of this. Low interest rates may have implications for those who are more dependent on interest income. Moreover, low interest rates can have undesired side effects, such as stimulating excessive risk-taking in financial markets. So they know this. And you just think that, of course, everybody knows this, but still central banks have been pushing the interest rates to zero, deposit rates to negative, and they have been massively buying kind of different bonds and other stuff. So it's obvious that central banks must be aware that their major actions, which they have been forced to do, first to keep kind of market floating after the global financial crisis, and then Euro crisis, and now COVID crisis. So this has had kind of direct consequences on pricing equities, pricing bonds, pricing real estate, and so on. This is something that as I just suggested earlier, that while in the US, you can every now and then see, while the Fed kind of local representatives might come to public and share their different views from Fed's policy. In Europe, this is not typically the case, but there are sometimes, especially kind of from German representative in the ESE ECB board. So this is an example from this December. Schnabel said that the ECB's bond buying project has been policy had inflating asset prices and creating risk of financial instability. Bond purchases increase moral hazard and excessive risk-taking overvaluation. Okay, so he's right. Kind of, you could say that. How can you disagree with him? The question is that okay, what had been the other option had European Central Bank not been this active in the markets? So what had been the kind of end result? So it could be even worse. So that's it. We can see that even in Europe, you can see ECB bosses coming to the public and kind of having different disagree with the general policy. Other central bank goals could be, besides all the previous ones, could be that central banks have some green finance policies. And now this is just to give you a framework for your term paper. So this is a new thing for central banks, as we can see from the material. Once you start preparing the term paper, you know that, okay, this is where this is linked. This is a new thing. Inflation has been pretty common in kind of as a goal. Employment plus new also kind of this green goal. So that is the reason I chose this greenness as a topic for term paper. Pretty interesting kind of a topic area, as it's such a new. And as you will see, it's not that black and white whether central bank should be active on this. You can have a kind of differing opinions. Then we have learned a lot, as central banks have learned themselves a lot since financial crisis. What different tools one can and should use: quantitative easing, the round start in the US, and forward guidance. So nowadays, European Central Bank also is following the forward guidance. In July 2012, this is something that I once referred to. Mario Draghi, then the president of the European Central Bank, said these famous "whatever it takes" words, implying that European Central Bank will buy any bonds if really needed. We have gone through these AQR stress tests in 2014, a series of targeted long-term refinance operations. I will explain you this in a minute. And ECB also has since 2015 announced a massive expansion of its asset purchase program. And next, I know this is not the optimal way to kind of to show this, but just kind of I can't figure out any other form than just many slides on which I highlight kind of how European Central Bank has, what kind of tools they have adopted over the years and how the policy has changed over the years. But just to kind of go through this, the idea is that you just taking a snapshot of the policy of European Central Bank today, you can't really understand why we are here as we are, how we ended up in this position in 2022. To understand why we are here, we need to take a look at kind of a couple of years back. So please take a look at this kind of the timeline. To understand, okay, this is where we are. It's not that we European Central Bank decided, okay, we want to be in this position in 2022, but we just, for various reasons, this is where we have ended. First, 2014, there was a subdued inflation outlook. Inflation has been much lower than this 2% for many years. There are additional monetary policy measures since 2014. Three main elements the policy package introduced in 2014 were: first, reducing the key interest rates to the effective lower bond. So then it was, okay, zero is lower bond. Introducing a series of targeted long-term refinance operations and launching 2 purchase programs for selected private sector assets. What are these somewhat kind of a, this is ECB refers every now and then. This is, Fed does not use these LTROs or TLTROs. They have the tools that European central banks have been using for quite some time and pretty massively already. First, when the Euro crisis hit, so then European Central Bank launched something called LTRO. So that is long-term refinancing operations. So essentially what they said, they told the banks, European banks, that you can borrow from us on a very affordable terms if you like. And that was something that kind of has never been done. And then banks needed to just inform the ECB that, okay, we want to borrow at the very cheap terms. Why didn't all banks kind of borrow? That was considered to be a bad signal for stakeholders and shareholders, especially if it became kind of a public knowledge that one bank is forced to borrow at the very cheap terms. So many banks came to public and said that we are not borrowing, we are not participating in this long-term refinancing operations. Okay, that was one exercise. It was executed and done, and it's finished. Then something that has become kind of the tool that European Central Bank seems to like is targeted long-term refinancing operations. So what essentially that is, that central bank tells to banks that you can borrow from us at the very attractive terms if you promise that that money you will lend for corporates, for real kind of investments, and for households, but not for mortgage loans. So not for kind of a speculative purposes. And then asset purchases were another kind of a asset purchases, APP, asset purchasing program, another round kind of massive, which we will discuss later. As an example, so what these TLTROs are, when the first round was announced, so Aktia was one of the banks which said in an annual report that Aktia Bank aims to increase its corporate lending and participated for the first time in the European Investment Bank's longer-term refinancing operations, TLTRO, which enabled Aktia put 100 million into the market in the form of Aktia financing with favorable terms. So what these favorable terms were, on the second round, 2016, here I have underlined this, the rate that can be as low as the rate on the deposit facility at the time of allotment. So essentially what these targeted long-term refinances operations have been, remember why ECB would explain why ECB decided these long-term refinances operations were. First, interest rates were so low, and they will also because European Central Bank kind of forced them to zero bound already itself. So banks were facing major kind of profitability challenges. Okay, ECB told banks that, okay, we know that you are facing challenges, but you can borrow money from us at the cost of deposit facility, which is negative. So the cost is negative. So just to push you, kind of incentivize you to borrow money from us, you get money if you borrow from us, as long as you promise that you will forward this to your clients, which makes some real investments. So this was round one. This is 2016 was round two, and obviously this was to help banks in the profitability challenges, plus kind of incentivize banks to lend, which was kind of push the economy kind of to grow. 2016, this is kind of explaining this the Eurozone banks were severely exposed to negative rates. So this is, of course, Draghi understands this. These targeted long-term refinance operations allowed banks to borrow from central bank at the minus 0.4%, so negative rate. Very quickly, kind of a statistic, which countries banks have utilized this most. These Italian, Greece, and Spanish banks have, relative to their reserves, they have borrowed, they have used this opportunity from the ECB most. 2015 asset purchase program, and this is very interesting. If the ECB still had room to cut interest rates, it would have done so already. But now the interest rates were on the zero level already, or even the deposit rates were negative. So that tool was kind of used. You can't have a minus 2% interest rates. Why not? Kind of if you think of you as a depositor, and the bank says that the deposit rate is minus 2%, would you put your money on the bank? No. You rather keep that in cash or whatever, put it somewhere else. So it can't be much negative. It seems to be that this minus 5 or whatever, it's acceptable because it's safe and it's kind of convenient, everything. But it can't be, used to be the thinking that it can't be negative at all, but now customers are accepted that it can be somewhat negative. But obviously we have reached the lower bound, so we can't lower the interest rates anymore. ECB cannot lower the interest rates anymore. So this option is no longer possible, so they needed to go for asset purchase program, so start buying different assets. In 2016, the deposit rate was minus 0.4, and they raised the amount of bonds that they buy each month under quantitative easing. They used to be buying, they told this in advance that they are buying every month. They buy worth 60 billion, but that was increased to 80 billion. And they also expanded the range of assets, so not only they buy government bonds, but they can buy other, say, mortgage-backed securities as well. Let's jump over this. This is kind of just confirming the 60 to 80. That's what 2016. Now we come to 2017. Now they came to conclusion that we can cut this bond buying, program to 30 billion. So there is not that much need to buy anymore. So we can start kind of, you could say, tapering. So they thought, okay, we are not that much needed, our activities are that necessary anymore. 2017, they also, that is also, they refer to tapering. They say, okay, we will keep interest rates at the record lows, minus 0.4%, but they are able to scale down on these purchase operations. 2018, they said that we are planning to end this massive bond buying program in December. So note this, 2018. And then now we come to the announcement that we had already kind of at the beginning. This is from 2019. Why the reason I suggested that this is very, very interesting, kind of also showing kind of what these announcements, these releases are like, but the content one also. Remember, they said a year ago that they are scaling down and actually they are going to stop this purchase program. What they needed to do was that interest rate or deposit facility will be decreased by another 10 basis points to minus 0.5. So it was 0.4, minus 0.4 for a long time, but it looked that economy is not recovering, inflation is not picking up, so they needed to go further down to minus 5%, minus 0.5%. Plus, net purchases will be restarted. So they needed to come back and start another round of buying. So just kind of in a way, this is ECB, kind of a just showing that kind of to answer indirectly, to your question earlier. How do you think that Fed can kind of take steps back? In theory, you can easily take steps back, but if it happens that the economy doesn't pick up, or kind of inflation doesn't pick up, or there will be recession or whatever needs, so kind of it easily happens that you need to come back, and that is what happened in 2019. Remember, this is before COVID. COVID came in 2020, so they needed to come back and say, okay, we start another purchase program. Plus, they started TLTRO3, kind of another round of kind of targeted long-term refinancing operations, another round of kind of offering banks, and now the cost was -0.5. So kind of banks do receive 0.5% annually on any amount that they borrow from the central bank. So this, you can say that very unconventional, unusual tools have been used by ECB. And then came COVID, 2020, something called pandemic emergency purchase program. They said that it's temporary, and they increase the purchase program to altogether to 1.8 trillion, so 1,850 billion. So that is 1.8 trillion. So massive increase in the purchase program. Now the latest from October last year, they still have the interest rates are kind of unchanged. Deposit rate is -0.5. The net purchases under this asset purchase program the pace is 20 billion. But they plan to end this PEP kind of purchase program in March 22. They continue targeted long-term refinancing operations, TLTRO3, so that seems to be an attractive source of funding for banks. So seems the tool that central bank likes. So this is where we are currently in Europe. And this is, as I promised, that this is from snapshot from yesterday's decision in the US. The Fed, they said that they could start raising interest rates in March, so in 2 months' time, with inflation well above 2% and a strong labor market. Say if the unemployment rate is 3.9, that's really sign of a strong labor market. Inflation 7%. Okay, you could say, okay, if you don't raise interest rate in this environment, when would you do that? And he also said that these asset purchases are likely to halt in March. And this was kind of the contents of yesterday's release. Is there any information kind of I don't personally see that there's not too much kind of a news in here. This is not what you might expect, but it was somehow kind of a bit small shock for the market that they really concretely said that kind of we really focus on inflation and we will move. Some analyst economists had been expecting even kind of a faster kind of increase in interest rates. So you could say that in light of that, this was not that dramatic move that Fed announced. Very shortly at the end, effect of interest rates on banks is something that we have been talking. As this article in Bloomberg said, crazy as it sounds, several European central banks cut their key interest rates below zero. So it is a very unorthodox move, has distorted financial markets, obviously. And this is what we can see. The deposit facility rate has gone zero, and it has been further kind of pushed down to -0.5. So banks knew, in terms of banks' profitability, it has been a major obstacle. As this one article from Standard & Poor's pretty well summarized that, as I have underlined there, the title is European banks must reinvent themselves in quest for profit. I've underlined there that net interest income still accounting for 58.9% of European banks' total income at the end of 2020. And you just think of the environment. If the interest rates are close to zero, you pay depositors zero, and then you lend money, and if your margin is, say, roughly 1%, so your interest margin is 1%. So there's a limit. Why it used to be when, say, I remember interest rates a few years ago, not that long ago, kind of interest rates were 5%. So you pay depositors 3%, and you charge from loans, say 6%. The interest margin was 3%. So this decrease in nominal interest rates have pushed kind of the interest margins, which is for many banks, which is the major source of their revenues. Plus, if you add here the cost that banks have on their deposits on European Central Bank, there's a cost. The deposit rate is negative. So this has had major effect on the banks, especially the banks whose business is on this borrowing, lending, kind of old school banking. As Standard & Poor's highlights, strong and diversified fee income. Remember, as we were discussing Aktia's kind of case, there have been one reason for even before this kind of pandemic or anything, they have been highlighting that the asset management is the way to grow. That is fee business. Fee income from areas such as capital markets, payments, insurance products, wealth management, trade finance. So the banks who have been active, and that's Nordic banks, if you look at Nordea, if you look at Aktia, if you look at many Nordic banks, they have been actively trying to grow this asset management and payments and insurance business kind of for many years, quite successfully so. If you look at Aktia's, as we took a look at their kind of first 9 months result last year, in terms of profit, they already made more in asset management than in traditional banking. That is not the case in many German banks, in many Southern European banks, and that is kind of keeps like a burden for those banks. Okay, any questions? Matteo is referring to Paul's Q&A. Okay, you looked at. Okay, I encourage you to others take a look at that as well. Aren't optimism-driven bubbles also driven by expanding investment on margin? Yeah, kind of. You are totally right. As I made a difference, kind of optimism or credit-driven, as if it was so simple. So to make a difference between two different ones. Typically, kind of the bubbles are driven by a kind of credit boom, which fuels kind of optimism, and asset prices go kind of increase. So kind of you are right. It is great. Optimism-driven bubbles are driven by investments, kind of on margin or kind of on borrowed money. So you are right. So as I said, bubbles are close to impossible to verify, to acknowledge, to identify when you are in the bubble. Afterwards, you can see that. And that is, it's simply kind of because there are those many factors, kind of you said that in current environment, as an example, our stock market expensive. Everybody says the stock market is expensive. Relative to the interest rates, which are zero, so anything that generates kind of cash flow, its theoretical value can be anything. So you could say that if you believe that interest rates will stay under zero, so there's no reason kind of not to sell any shares, as the net present value of future cash flows, if they are positive, can be anything. But if then the question is, you must take some kind of stance on what to expect. Will Fed increase interest rates and kind of or will they stay low as they are currently? Matteo's kind of on Q&A, kind of you have very good questions, comments. As you could see, as I said, 8 minutes as a presentation, and then what is 45 minutes, 50 minutes kind of a Q&A. As he didn't say too much, but kind of on these questions and also the answers. As there's unemployment, as there's inflation, and kind of is playing with different kind of a few parameters, different scenarios. So what is the real informative content? So kind of I didn't find too much new from that, but kind of somebody even being able to make questions for these 50 minutes is kind of an interesting observation as such. Would the cause of inflation make a difference for the Fed? Inflation caused by issues of that is a very good question, and as such, I guess no. As Powell in yesterday's his presentation, she referred to higher inflation and also referring to kind of wages going up, further fueling kind of inflation. So is it demand or is it supply-driven inflation? That doesn't make a difference. Inflation target is close to 2% in the US. So and just as a I think I suggested once kind of it's always wise to be humble kind of in before you make any strict forecasts. As one example, central banks have not been able to forecast the inflation for the past 10 years. They have been expecting the formal kind of questionnaires among, say, European Central Bank have suggested that economists who work at the European Central Bank have expected that next year the inflation will be approach 2%. It has not for almost 10 years in a row. So even central bankers can't forecast inflation, and they must be the best informed agents in the markets. Plus, they have the tools to influence the inflation, and even they have been wrong. So the question is that how could they be right now? So that is just, I'm not smiling or laughing at central bankers. I'm just telling you that forecasting inflation is almost impossible, because as an indication that you can't even expect that, explain that afterwards why it didn't pick up. So forecasting is very difficult on the level, and further, as you Nestor referred to, kind of what is the driver? Is it kind of the demand, supply, other kind of the now challenges in the supply chain? So it's to admit that it's impossible. I guess that is the best way to go. Kind of not to kind of claim that I know what it will be. So that is central bankers' kind of a task is for many reasons kind of so challenging currently, and that's why kind of whenever kind of any central banker, Christine Lagarde or Powell will have a next big kind of a public speaking, I will always watch them, and even though it would be not that informative, still kind of interesting is kind of how they explain kind of their view. What is obvious, and that is that is kind of something that became finally concrete yesterday, was that while Christine Lagarde's last week's interview, she said that we are not in a rush interest rate, we are not in a hurry. In US, Powell confirmed that they are on the path of increasing interest rates. So US economy is kind of much more stronger, and inflation is not transitory, but kind of a pretty wide. When in Europe, ECB is kind of following. Do they follow? Will they do anything? Remains to be seen. But at least in Europe, it seems that there is no risk that kind of the probability that they will follow Fed quickly, kind of in the near future, is pretty low. Good. Any other questions you might have? You can send me email. You can add here, since it's very difficult to forecast future. Therefore, not. I will read this Wikipedia article. Thank you, and thank you, Olli. And then might return this on K% rule. Okay, that's good. Very interesting. Actually, first time I hear about this. I will take a look at that. That's for sure. Okay, if that is okay, enough for today. That is central banks. Next Tuesday, we'll talk about the regulation, which we have kind of touched upon a few times. Pretty interesting kind of development in that area as well. So remember, tomorrow, Friday, 4 o'clock deadline, and then next Tuesday, we'll talk about regulation. Cheers.